In previous videos, some of you asked me about my thoughts on the timing of the next stock market crash and what I think might happen. Taking your requests into account, I decided to make this video. So, let's get started. To answer this question, we first need to look at historical crises and their causes. If we examine history, we see that the US stock market has experienced several major crashes since the 20th century. For example, during the Great Depression in October 1929, the Dow Jones Index fell sharply after a brief period of extreme speculative bubble. Between 1929 and 1932, the market lost around 90% of its value, and the stock market only returned to its previous peak in 1954. In 1973–74, the oil crisis caused the S&P 500 index to drop by 48%. At that time, the OPEC oil embargo, political turmoil, and the Watergate scandal occurred simultaneously, driving inflation up and creating economic stagnation. Later, the Black Monday crash in October 1987 caused panic worldwide. On October 19, 1987, the Dow Jones fell 22.6% in a single day, wiping out approximately $500 billion in market value. This event demonstrated the unexpected impact of automated trading and new financial instruments. Moving closer to the present, the dot-com bubble in the late 1990s led to extreme overvaluation of technology stocks between 2000 and 2002. The Nasdaq peaked in March 2000 and then fell by nearly 80%, resulting in over $5 trillion in lost market value. The 2008 global financial crisis emerged from the subprime mortgage collapse. On September 29, 2008, delays in the U.S. Congress approving a credit aid package caused the Dow Jones to drop 777.68 points. During this crisis, the Dow fell more than 50% from its 2007 peak to March 2009. Finally, in early 2020, the COVID-19 pandemic triggered a collapse in which the S&P 500 lost 34% of its value in just 33 days, marking the fastest bear market in modern history. Historically, the main causes of market crashes fall into three categories. First, the bursting of speculative bubbles, where stock prices rise disconnected from fundamentals and then collapse sharply. Second, panic selling, which can be triggered by wars, unexpected economic downturns, or financial crises, as seen with the Lehman Brothers collapse in 2008 and the rapid spread of COVID-19 in 2020. In such cases, negative news spreads quickly and often leads to exaggerated selling. Third, global shocks and policy changes, such as oil shortages, trade wars, or sudden tariff hikes, can trigger sudden market collapses. According to Investopedia experts, most major crashes result from a combination of excessive leverage, speculation, and unexpected shocks like wars or pandemics. Considering the likelihood of a crisis today, key U.S. economic indicators in 2025 are relatively stable, unemployment is low, and consumers remain active. However, certain risk factors exist. A significant portion of the stock market is tied to tech companies, many of which have high valuations. For instance, Nvidia's P/E ratio has reached 57, while the market average is around 18. This has led some experts to label the market as a speculative bubble. While the Federal Reserve has historically supported the market with stimulus policies, interest rates are currently relatively high. According to EBC Financial Group's August 2025 analysis, the projected P/E ratio of the S&P 500 is around 22 to 23, and the Shiller Cape Index is approximately 38. Such high valuations increase market risk, meaning even a small economic slowdown could trigger a 10 to 20% correction. Trade balance issues, national debt levels, and U.S.-China trade relations are under control, but concerns remain about the potential impact of tariff increases. For example, UCLA's 2025 forecast notes that if new administrative policies, such as higher tariffs, large-scale job reductions, or cuts to the immigrant workforce, are fully implemented, this could create simultaneous economic contractions in multiple sectors and potentially lead to a recession within the next 1 to 2 years. Global institutions appear more optimistic. The International Monetary Fund predicts about 3% global GDP growth in 2025 but admits that even this level of growth cannot fully prevent shocks that could ignite market volatility. Therefore, while current macroeconomic indicators do not suggest an immediate market crash, unexpected factors, such as geopolitical tensions, credit crises, or new pandemics, could trigger a collapse at any time. Looking back at October 19, 1987, Black Monday, the New York Stock Exchange floor was tense. The Dow Jones fell 22.6% in a single session, eliminating roughly $500 billion in market value. Such dramatic crashes show that even with precautions, crises can occur unpredictably. Experts disagree on the timing of the next crash. Ray Dalio Dalio, founder of Bridgewater Associates, warns that if the U.S. budget deficit is not controlled soon, the country could face an economic heart attack within the next 3 years. He believes that unless the federal deficit is reduced to around 3% of GDP, the debt burden will grow and lead to a serious crisis. On the other hand, NYU professor Nouriel Roubini suggests a soft recession by the end of 2025. He predicts that due to new tariffs, the U.S. economy might slow in Q4 2025 but does not expect a long-term collapse. Technological advancements, including AI and robotics, could revive the economy. Roubini estimates that tech progress could boost U.S. growth from 2% to 4% annually over the next decade. Other economists express caution as well. Torsten Slok of Apollo Asset Management notes that the top 10 companies in the S&P 500 are currently more overvalued than during the dot-com bubble. Investment analyst Jim Bianco reminds us that being truly agile in technology does not guarantee stock prices are fairly valued, advising caution based on the 2000 experience. Experience shows that even when the market appears overvalued, it is impossible to predict the exact moment of a crash. As the Atlantic Journal points out, no one knows precisely why the market rises to such levels or when it will end. For instance, in April 2025, a newly announced tariff policy caused a 12% market drop in a single week, but when the tariffs were rolled back, the market quickly recovered. This shows that political decisions can temporarily impact the market, but the duration of this effect is uncertain and depends on policymakers. In conclusion, history shows that stock market crashes are not rare and occur periodically. After each crash, the market recovers, usually within about 2 years. However, after 1929, recovery took 25 years, whereas in 2020, the market rebounded in just 5 months. In my personal opinion, rather than trying to predict the exact timing of a market crash, it is smarter to develop strategies that allow you to stay grounded during these downturns. We cannot control market crises, but we can control how much they affect us. For example, history shows that the technology sector is often the most affected during crises. Therefore, instead of concentrating your portfolio in one sector, you can diversify by including companies in sectors that receive cash flow during wars, pandemics, or political tensions. Most companies do not completely fail during crises. They usually lose significant value, causing stock prices to drop. Naturally, some companies go bankrupt, but this is rare. By investing only what you don't need immediately and keeping cash reserves, crises can become golden opportunities to acquire shares of high-quality companies at lower prices. I would like to cover in more detail how to act during a crisis. If you show interest in this topic in the comments and likes, in the second part of this video, I will explain how to turn a crisis into an opportunity, potentially gaining wealth during these rare moments that few people ever experience.